Assalamu alaikum students. I hope you must be good and doing well in your study and enhancing your knowledge. So once again welcome back to my economics class. Let's start our today's e-learning session. So we are continuing from our chapter number 9, that is fiscal economics. It is the fifth part of this e-learning session of this particular chapter. So it would be the last session of this chapter. So let's have a look on the topics which we are going to cover in this video. So today is a very interesting topics we are going to study. First of all, we'll see what is the meaning of budget and its types. And the second one is related to the budget also, that is meaning and types of budget deficit. And the third one we are going to study is meaning and principles of federal finance. And the last one topic is meaning and objective of fiscal policy. Let's start the video with the meaning of budget. So a budget is an estimate. Estimate means prediction. Prediction of income and expenditure for a future period as opposed to an account which records financial transaction. So basically budget is nothing but the estimation. It means prediction of income and expenditure for the future period. So basically it is the general meaning of budget. So budget is an essential element in the planning and controlling of the financial affairs because income and expenditure do not occur simultaneously. We receive income first and we have to spend expenditure then, or it can be vice versa. So now we will talk about the national budget. National budget set out the estimates, the prediction of government expenditure and revenue for the financial year. Financial, you know very well that that is accounting year, which starts from 1st April to 31st March, and is normally presented by the finance minister to the Indian Parliament on 1st of February every year. You should remember that the date has been changed now. Earlier it was presented on February 28, but now it has been changed to February 1st. In the statement, the finance minister reviews the economic condition and government expenditure for the past year and makes the forecast for the coming year and announce the changes in the taxation. Basically, when the finance minister announced the budget in the parliament, the finance minister first uh, explained the detail of the financial condition of the economic condition in the past year. Then he announced the budget for the coming year, coming financial year. Now you just understood the meaning of budgets. Let's have a look on the types of budget. Which are the main types of budget. So the first one is the revenue budget. So revenue budget is consist of revenue receipt and revenue expenditure. So basically wherever you heard the word revenue, it means it deals with current or it deals with the time period of 1 year. Moreover, the revenue receipt can be categorized into tax revenue and non-tax revenue. You just have learned in the previous videos about the tax revenue and non-tax revenue. So basically, revenue receipt includes the tax and non-tax income, and it includes the revenue expenditure. Those expenditure which do not create any asset in the economy. You know very well that is expenditure. Expenditure means with the money which is spent by the government in the country. Okay, but the government is spending that money which do not create any asset in the economy. Can be the expenditure of health or scholarship, or you can say pensions. Okay, so let's move to the next type of budget, that is capital budget. So capital budget consists of capital receipts and capital expenditure. In this case, the main source of capital receipts are loan and advances. Here I want to clear you that In the revenue budget, I just explained you that it consists of revenue expenditure and revenue receipt. And the revenue receipt includes tax and non-tax sources which do not create any liability on the government. But in case of capital budget, which include the capital receipts and capital expenditure, so in this capital receipt, it creates the liability for the government because the government is raising the money through borrowings and loans. On the other hand, capital expenditure can be categorized into planned capital expenditure or non-planned capital expenditure. In short, it means it includes those expenditure which create a asset in the economy, like the money spent on the construction of a school building or construction of a hospital, government hospital. It means it is creating a asset in the country. So you can easily differentiate now what is the difference between revenue budget and capital budget. Revenue budget do not create any asset or any liability for the country, for the government, but in capital budget, it create asset for the country and it also create liability for the country. Now let's move to the next type, that is supplementary budget. During the time of war or emergency or natural calamities like tsunami, flood, etc., the expenditure allotted in the budget provisions are not always enough. Under these circumstances, supplementary budget can be presented by the government to handle the unforeseen events. So now we are moving to the next topic, that is budgetary deficit. Now I just have cleared you the meaning of budget and the types of budget. Now it's the very important topic to learn, that is budgetary deficit. Deficit means deficiency, shortage. Okay. You know very well that while the government is estimating about the income and expenditure of the country in the coming year, it is so obvious that our country never receives the income more than the expenditure. It always happens in the developing country because the developing country have to spend a lot of money for the development of the country. So that's why this kind of gap occurs. So let's have a look on the budgetary deficit meaning. So budget deficit is a situation where budget receipts are less than the budget expenditure. As I mentioned here, that the budget expenditure is greater than the budget receipts. Let me give you an example. Suppose our country earns rupees 80 as an income, but the country have to spend rupees 100 on the country. The difference is of 20 rupees. It means it is the deficit. It's a very simple example I gave you, but this is actual the meaning of deficit, the budgetary deficit. Now you have to look on the budget receipt. What is budget receipt? It includes the revenue receipt and capital receipt, which do not create any asset or liability. I explained in the earlier slide. And here I explained the budget expenditure. It means it includes revenue expenditure and capital expenditure, which create asset as well as the liability for the country, for the government. Now have a look on the types of budget deficit. There are so many types of budget deficit, but we have four main budget deficit. The first one is revenue deficit. Second one is budget deficit. Third one is fiscal deficit. Fourth one is primary deficit. We'll have a look on these points one by one. So have a look on the first type of budget deficit, that is revenue deficit. So it refers to the excess of revenue expenditure over the revenue receipts. So basically when the revenue expenditure is greater than the revenue receipt, it is known as revenue deficit, means shortage of money for completing the expenditure of revenue. So, or you can say that, or if you want to calculate the amount of revenue deficit, we have a formula for that, that is total revenue expenditure minus total revenue receipt. That would be equal to the revenue deficit. So I just gave you the example, like if the revenue expenditure is 100 and we just earned the money of rupees 80, then the deficit would be 20. So this is the meaning of revenue deficit. Let's have a look on the second point of type of deficit. Second point is budget deficit. Budget deficit is also, I mean, wherever you heard the about word of deficit, it means shortage. It means the expenditure is greater than the receipt. Okay, here the budget deficit means the total expenditure is greater than the total receipt. And if you want to calculate, we have the formula also, that is total expenditure minus total receipt, that is equal to budget deficit. So the next point is fiscal deficit. You just learned about the budget deficit. Now, when you add the government's market borrowing, you know very well, to complete the expenditure, the government have to depend on the other sources of financial institution, or they have to, I mean, the government have to borrow the money from many financial institution. It can be of foreign also. So budget deficit plus that type of borrowing, when it is included, it is known as fiscal deficit. The last type of budget deficit is primary deficit. So primary deficit is equals to the fiscal deficit minus interest payment. I mean, I just told you na, that the government have to take the loan from the financial institution, then they also have to pay the interest for that borrowing. And if you want to calculate the primary deficit, primary shortage, then you have to reduce the interest payment amount in the fiscal deficit, then you will get the primary deficit. Now let's move to the next topic, that is federal finance. So let's have a look on the meaning first. So federal finance refers to the system of assigning. Assigning means giving the source of revenue, whatever is received by the government, that have to be shared among the central government as well as the state government for the efficient discharge of their respective functions. I mean, clear cut division is made regarding the allocation of resources of revenue between the central and state authority. It means that whatever is earned by the government, that should be divided properly to both the government, that is both the central and to the state governments. The kind of federal finance, which is a term in economics. So we will have a look on the principles of federal finance. I mean, what are the rules which must be followed while distributing the revenue to the central and state government for using that fund for their, I mean, citizen, for their public. Let's have a look on the principle. What are the rules which should be followed? Are the principles of federal finance. So the first one is principle of independence. So under this system, the government should be autonomous and free about the internal financial matter concerned. As I told you, that the state and the central government will get accordingly their source of revenue. Later on, they can't interfere in their matters, in each other's matter. I mean, the central can't interfere in the state, and the state can't interfere in the central government decision regarding the revenue expenditure. I mean, how they're gonna spend the money, they can't interfere. So that's why the first principle is independence. They are independent to spend whatever they want to spend for their respective citizens. So the second one is principle of equity. From the point of view of equity, the resources should be distributed among the different states so that each state receive a fair share of revenue. I mean, whatever is distributed among the states, that should be equal enough. I mean, that not should be so much excess to the one state and so much less amount given to the other state. So the next principle here is principle of equity, equality you can say. So the next point is principle of uniformity. In a federal system, each state should contribute equal tax payment for federal finance. But this principle cannot be followed in practice because taxable capacity of each unit is not the same. That's okay that you can apply a same type of tax rate in every state, but it is impossible to get the same amount of tax from the state, because you know very well there are a lot of people living in one state. I mean, their income is very high. Obviously, they will give the large amount of tax to their state government. On the other hand, it can be vice versa. So the next point is principle of adequacy or of resources. The principle of adequacy means that the resources of each government, that is central and state, should be adequate to carry out its function effectively. I mean, whatever they are receiving, that should be enough for them to function the things which they want to do. So, here adequacy must be decided with the reference to both current as well as for the future needs. Let's have a look on the fifth point, that is principle of fiscal assess. In a federal system, there should be possibility of the central and state government to develop new source of revenue within the prescribed fields to meet the growing financial needs. Whatever they want to introduce in their system, they can introduce, because there are so many expenditure which can't be completed by the given revenue. The next point is principle of integration and coordination. So the financial state system as a whole should be well integrated. There should be perfect coordination between different layers of the financial system of the country. Then only the federal system will survive. This should be done in such a way to promote the overall economic development of the country. Here we are giving the freedom to both the central and state government, but their target must be same, that is the development of the whole country here. That's why there must be the coordination between every financial system layers. The next point is the principle of efficiency. The financial system should be well organized and efficiently administered. There should be no scope for evasion and fraud. If there is any fraudulent activity, then it can hinders the success of the economy. So, no one should be taxed more than once in a year. Double taxation should be avoided. Next point is principle of administrative economy. Economy is the important criteria of federal financial system. That is, the cost of collection should be at the minimum level and the major portion of revenue should be made available for the other expenditure outlay of the government. So basically, you know very well that the government spent amount while collecting the tax from the public, and they are saying in this principle that it should be, I mean, minimum amount of money should be spent on the collection of tax, so that the huge amount must be saved for the main purposes. So the next point is principle of accountability. So each government should be accountable to its own legislature for its financial decisions. I mean, the central government should answer in the parliament and state in the assembly. So the next topic here is meaning of fiscal policy. I wrote here, you can see clearly that fiscal policy is the mechanism by means of which the government make adjustment to its planned spending and the imposed tax rate to monitor and thus in turn influence the performance of a country economy. So basically it relates with whatever is government receiving as a revenue and in what sector, in what form they have to spend their money. It is the management of this fiscal policy basically. So it is implemented along with the monetary policy by means of which the central bank of the nation influences the nation's money supply. So basically, how the government manages the amount of received money, received income into the public spending is known as fiscal policy. So how the government do this? They have their main financial or fiscal instruments. Let's have a look on that instruments. So before looking the instruments, first have a look on the definition which is given by author. So the term fiscal policy refers to a policy under which the government uses its expenditure and revenue programs to produce desirable effects and avoid undesirable effect on the national income, production and employment. So basically the instruments, fiscal instruments are three here. First one is taxation, second one is public expenditure, third one is public debts. Let's have a look on these points one by one. So the first point here is taxation. I just told you that government manages this economic growth through these instruments. So the first point here is taxation. So you can see the picture clearly first. The government always raises the tax, always increases the tax to control the inflation. I told you many times that inflation is a situation where when there is a rise in the prices. And why it happens? Because the demand is greater in the economy than the supply. Why the demand is greater? Because the people are having a lot of money in their hands. And to control this situation, the government increases the tax. It means that the government will increase the tax and the people have to pay a huge amount of tax, and they will be remained with less amount in their hands, and it will helps in the control of inflation. In the same way, when the government want to reduce the deflation, they will decrease the taxes. So the second point here is public expenditure. So public expenditure raises wages and salaries of the employees and thereby aggregate demand for goods and services. Hence, the public expenditure is raised to fight the recession and reduce the control inflation. So in simple words, the government increases the public expenditure when there is a need to control the deflation, and when there is a need to reduce the inflation, then they decreases the public expenditure. So the next point here is public debt. I wrote the 2 points which are very important, that when the government borrows by floating a loan, there is a transfer of fund from public to the government, because I told you government also requires fund when there is an emergency. And when the government borrows the loan, it transfers from public to the government, and at the time of interest payment, when in the first point the government borrowed the fund from the public, and the next point they have to pay the interest on that particular public loan, public debt. At that time the fund is transferred from the government to public. So it's a time to have a look on the objectives of fiscal policy. There are total 7 points of objective of fiscal policy. So the first point is full employment, second is price stability, economic growth, equitable distribution, external stability, capital formation, regional balance. Let's have a look on these points one by one. So the first point here is full employment. Obviously, it is the very, very important point in the mind of the government to provide the full employment in the country. So, full employment is the common objective of fiscal policy in both developed and developing countries. So, basically, the government always focuses on the employment level in the country. So, in India, public expenditure on rural employment program like Manrega, that is Mahatma Gandhi Manrega scheme, in which it is aimed at employment generation. This scheme provides the 100 days working for the poor people, for the laborers to earn their earning. So the next point here is price stability. So first of all, what is price stability? When there is a hike in the prices, or when there is a huge amount of decrease in the price, that is known as price stability. Why it happens? Because when the aggregate demand is greater than aggregate supply, it results in this type of situation. And when the aggregate demand is greater than the aggregate supply, it means it creates the situation of inflation. Here you have to look after this, that if the inflation is created by the public expenditure, then the government will focus on the cut down of public expenditure. They have to look after this, that why the inflation occurred, because of public expenditure, or because if it occurs because of private expenditure, then the government's main tool to handle this situation is increase in the taxation. I mean, the government will increase the amount of taxation, then the people will have less amount of money in their hands, and it will help to improve the situation of inflation. And in case of deflation, the government will decrease the taxation to avoid the situation of deflation. So the next point here is economic growth. So fiscal policy is used to increase the productive capacity of the economy. So they provide tax rebate or tax holidays. What is this? When the government exempt, when the government relaxed the taxations policy for the industries, for those industries which set up their system, which set up their industries in the regional areas, in the backward areas. So for the development of that particular area, the government provide, I mean, tax holiday. They exempt them. They do not, they say them that they do not need to pay tax to the government. They just have to focus on the development of this, that regional part of the country. So this is also the one of the objective of fiscal policy. So the next point is equitable distribution. So you know very well that in our country progressive rate is followed. It means higher the income, then the tax rate would be high, and lower the income, the lower the tax rate would be there. I mean, the burden is on the rich, and rich of paying the tax. Why this is in our country? Because they want to control this situation, because in I mean on almost every type of, in every country, rich are getting richer and poor are getting poorer. So this is the situation. To reduce this gap, the fiscal policy focuses on the progressive rates. Okay, so the next point here is external stability. So you know very well that there is I mean fluctuation in the foreign exchange rate, which tend to decrease the value of Indian rupee in the market as compared to dollar, as compared to other foreign exchanges. So what does it affect on the export? That the export get, do not get much profit. Why? Because they have to, they are I mean getting less amount of income as compared to their cost, because the amount, the value of rupees is less. So tax concession, subsidy to export oriented units help to boost export. Custom duty on import of non-essential items helps to cut import bill. The reduction in import duty on import of raw material and machinery enable reduction in cost and make the export competitive. So the next point here is capital formation. It is very interesting point and important one also. So when the tax reliefs helps to increase in disposable income. Disposable income means the amount, the money which is in the hand of the people after giving the tax. So when the people are having more money in their hands, they like to, they would save their money in bank. What the bank will do? The bank will lend the money to the industrialist. So what the industrialists will do? They invest the money in the industries, in the projects. It will form the capital formation. The money will be generated. The profit will be generated in the economy. So this is also one of the another, I mean, objective of fiscal policy. So the next point is, last point is regional balance. So fiscal incentives for the industries in the backward region helps to narrow down the regional imbalances. You know very well that in our country, metro cities are much more developed than the villages, than the backward areas. But the government have to focus on these areas also. So that's why in the fiscal policy they mentioned many incentive to those industries which are opening in the regional areas, which are opening in the backward areas, because it helps in the development of these industries. So now it's the time for you people to have a look on the assignment questions, and you have to complete on these question on time. The first question is give the meaning and explain the types of budget. The second question is what is budget deficit and explain its types of budget deficit. Third question is what do you mean by federal finance and explain the principle of federal finance. The fourth one is give the meaning and explain the objective of fiscal policy. I hope you enjoyed the video and I hope it would be a knowledgeable video for you people. That's all from my side, students. Thank you. Assalamu alaikum and take care.